Okay, so when we talk about stock, it's called paid in capital. So it's capital that's paid into the organization, but it's not what they call an equity sources, right? I mean, it's not a debt source where we borrow money from a bank in order to get money into our company to run it. It is an equity source. So we can have paid in capital in common stock or preferred stock. So you're going to notice here that if you look at the top box in blue, you'll see it says paid in capital in green on the left. And then you go to the next column and it shows common stock account and then preferred stock account, right? To the right of that are the actual account titles. So we have paid in capital in excess of common, well, this is the excess part. I'll explain it after, but what I want you to see here is that there's 1, 2, 3 actual titles that you could have for common stock, and 3 that you could have for preferred stock. So we have common stock, we would debit common stock, paid in capital in excess of par common stock. You could also have paid in capital in excess of stated common stock. And we're going to look at both different ones. So it could be stated common stock or par common stock. The next one is preferred stock. So we're going to have a new account called preferred stock, or we've had preferred stock before, we just haven't used it. And then we're going to have paid in capital in excess of par preferred stock, or paid in capital in excess of stated value preferred stock. So we can have all of those different ones. Okay, so I misstated. It is, you credit common stock when you issue stock, but I'm not going to go to entries at this point, okay? We're going to go over and look at the next slide. The other is retained earnings, and we've already talked about retained earnings. That's what we do when we do the retained earnings statements, right? We go through and we do the net income minus plus the prior retained earnings minus any dividends, and that gives us the retained earnings that we move forward. So how do we do the accounting for common stock or preferred stock? So here's the thing. We're going to go over the instruction for common stock. And the way you do it for preferred stock is exactly the same, except the account title is different. So if you're dealing with common stock, the account title is common stock. If you're doing preferred stock, the account title is preferred stock. So when stock is issued, they maintain a difference between what the value of the stock is and if you sell it above what the value of the stock is, which would be excess of the paid in capital. So that's what the slide here is talking about. So we're going to look at a sample here on this slide. Okay, so Hydroslide issues 1,000 shares of $1 par value common stock. Prepare the slide journal entry if A, 1,000 shares are issued for $1 per share. So in this case, in section A here that you see on the screen, for A, the value of the stock and what you sold it for are the same. So there's no excess. We're going to take 1,000 shares times $1 a share. That's $1,000. You'll debit cash $1,000 and you'll credit common stock $1,000. You've done that before. That's from prior chapters a long time ago. Now, B, 1,000 shares are issued for $5 a share. So now we have a difference between the value of the stock and what we actually sold it for. So in order to get the cash amount, we take the number of shares times what we sold it for. So we have 1,000 shares at $5 each. So that means we got $5,000 in cash. So we're going to debit cash $5,000. We're then going to credit common stock for the value of the stock we sold. So that's going to be the number of shares times the par value or stated value, depending on what the problem tells us. This problem tells us it's a $1 par value. So we take $1,000 times $1. That gives us the $1,000 that we credit. And then we take the difference between the cash and what the value of the stock is to get the excess. So we got $5,000 in cash. The value of the stock was $1,000. So the difference is $4,000. So we're going to credit paid in capital in excess of par common stock. Okay, so it's in excess of par common stock. If the problem told us it was stated, it would be in excess of stated common stock. So this is an example of an excess par value common stock entry. Okay, now when we go to the next slide, you'll see here that it's showing the section of the stockholders' equity now, and it's getting a little bit more advanced than it was before. Before we just had common stock, right? Now we have this section labeled paid in capital. We have common stock listed, and then below that we have in excess of par common stock. Now, if we also had preferred stock, we would have preferred stock listed in here as well. And your homework will have that on there, and it's in the book, and I can tell you what page to look at. You're going to look at illustration 11.16 on page 1123 for an example of how to do it with just the common stock. And then an example of one that has both common stock and preferred stock. You're going to go to 11-25 and it's do it exercise 4A. They're going to have an example there for you. And there's also one on the page before 11-24 that shows how to do the section for the financials, the balance sheet for the stockholders' equity section. Okay, so next one. So now we have a no par stock, and no par stock, when you do the entry, it's not listed as no par. The account is called stated. Now, why they just don't call it stated all the time, I don't know. But assume that instead of $1 par value stock, Hydroslide Incorporated has $5 stated value, no par stock, and the company issues 5,000 shares at $8 per share for cash. So first thing we do, we have to figure out our cash number. So we take the number of shares, 5,000 shares, times how much we sold it for cash per share, which was $8 per share. So 5,000 shares times $8 per share is $40,000. So we're going to debit cash $40,000. We then need to figure out the common stock number. So we're going to take the number of shares, 5,000, times the stated value of the stock, which is $5 per share. So 5,000 shares times $5 per share is $25,000. So we're going to credit common stock $25,000. And then the difference between the cash and the common stock is going to be our excess. And the difference in this case is $15,000. So $40,000 minus $25,000 is $15,000. So we are going to credit paid in capital in excess of stated value common stock. This problem says it's stated value, not par value, but stated value. Okay. So we would credit that $15,000. So that would be an example of an entry for common stock that's a stated value common stock. Okay. All right, so let's go to the next slide. Assume that the no par stock does not have a stated value and the company issues $5,000 for $8 a share. It's very simple. This is like how you did it before. It would be 5,000 shares times $8 a share is $40,000. You would debit cash $40,000 and you would credit common stock $40,000. Okay.